Good evening, everyone, and it is a great pleasure to see so many of you here. Maybe one day monetary policy will be sufficiently boring that you won't want to turn up, but I suspect not. Thank you very much, Richard, for your introductory comments. It's a great pleasure for me to be able to be here tonight speaking at CEDA's annual dinner. It's become a tradition at these dinners for the Governor of the RBA to talk about how we secure Australia's continued economic prosperity. And tonight I would like to continue that tradition. My focus is going to be on the importance of trust as an essential building block in economic prosperity. This focus is a bit different from the normal turf of economists, things like productivity, investment and capital accumulation. Of course, we do need to keep a close eye on those things. But in doing so, we should not lose sight of the fact that our economy, and indeed our society, works best when there are high levels of trust. And those in whom trust has been placed need to do their very best to be worthy of that trust. There's an element of trust in all economic transactions. Without it, commerce simply can't flourish. But the nature of trust in our society is changing. And unfortunately, we can all think of recent examples where trust in our institutions and organisations has been severely tarnished. And at the same time, changes in technology mean that we're increasingly trusting in the wisdom of the crowd on our preferred online platform rather than on traditional institutions. As some have argued, trust is now more likely to be distributed rather than to flow vertically from trusted institutions. This is a very significant change. But regardless of how trust is earned and retained in our modern economy, we all have a very strong interest in living in a high-trust society. And I'd like to use this theme of trust to talk about three broad issues this evening. The first is the role of trust in finance. The second is the importance of the community having trust that living standards will improve over time. And the third is trust in institutions. Here, naturally enough, I'll focus on the central bank and the importance of accountability and transparency. In this context, I'll end up with a few words about current monetary policy. As you all know, finance is mainly about trust. When a deposit is placed in a bank, we trust it's going to be repaid. We also trust financial institutions to invest our hard-earned savings for us, and we trust them to provide us with financial advice that's in our best interest. Without that trust, the financial system cannot operate properly and the economy cannot prosper. As the first line of the Banking and Finance Oath says, trust is the foundation of my profession, and I encourage everybody here in the finance sector to read that oath regularly and to more than read it, to actually live by the principles in that oath. Australia's banks have a very strong record of being worthy of the trust that's placed in them to repay deposits. The last bank failure in Australia that resulted in a loss to depositors was almost 90 years ago, back in 1931. And on that occasion it was a very small bank and depositors lost only a fraction of their deposits. There's a positive record that's shared by very few other countries. And this strength was again apparent during the financial crisis a decade ago, and it served Australia very well. The Australian banks are strongly capitalised and they have considerable liquidity. And on the whole, they've also managed credit risk effectively, reporting few problem loans by international standards. This means that we can have a high level of trust in the ability of Australia's banks to repay depositors. Indeed, our strong and stable banking system is one of the Australian economy's great strengths. It's in other areas, though, where trust has been strained. It's clear that the behaviours highlighted by the Royal Commission have dented the community's trust in parts of the financial sector. The case studies used by the Commission have put the spotlight on three very important issues. The first of these is the inadequate way in which banks have dealt with conflict of interest issues. The second is the way that poorly designed incentive systems can distort behaviour, promoting a sales culture at the expense of a service culture and promoting the short term at the expense of the long term. And the third issue is the fact that the consequences of not doing the right thing have, in some cases, been too light. Strengthening trust in our financial institutions requires all three of these issues to be addressed. Central to this task is creating a strong culture of service within Australia's financial institutions. Too often, our financial institutions prioritised sales over service. And correcting this starts with the system of internal reward established by the board and by the management. The vast bulk of people who work for Australia's financial institutions do want to do the right thing, and they do want to serve their customers as best they can. But like everyone else, they respond to the incentives that they face. If they're rewarded on sales or short-term objectives, it shouldn't come as a great surprise to us that that's what they prioritise. So establishing the right incentives here is key. One of the things that influences incentives is the consequences and penalties that apply when something goes wrong. Strong penalties can play an important role in incentivising good behaviour, and this is an area that we should be looking at. But we do need to get the balance right here, as it can have unintended consequences. In my view, it's worth making a distinction between the penalties that apply for poor conduct and those that apply for making loans that ultimately cannot be repaid. On conduct issues, we should set our expectations and standards high, and if they're not met, the penalties should be firm. On lending, though, matters are more complex. Even when banks lend responsibly, a percentage of borrowers will end up in financial strife and be unable to meet their obligations. So we need banks to be prepared to make loans in the full expectation that some borrowers will not be able to pay those loans back. After all, banks need to take risk and they need to manage that risk well. If they do become afraid to lend, simply because of the consequences of making a loan that goes bad, then our economy will suffer. So this is an area we need to watch very carefully. An appropriate balance does need to be struck. More broadly, having clear lines of accountability can help build trust. The banking executive accountability regime, the so-called BEAR regime, is helpful here. This regime, though, is largely limited to authorised deposit-taking institutions and to prudential matters. It is worth thinking about how the same focus on accountability can be applied to a broader range of financial services and to conduct issues as well. As we do this, though, we should not lose sight of the fact that it is banks' boards and management that are ultimately responsible for the decisions that the banks make. It's unrealistic, I think, to expect that an appropriate culture can be created through regulation and through penalties. Creating the right culture is the core responsibility of the boards and the management of our banks. Changes that are now taking place within the financial sector should, over time, help restore trust. I think it's going to be a slow and gradual process, though. The Royal Commission will have some recommendations that will hopefully assist with the process as well. One thing that would help is for financial institutions to have a long-term focus and reflect that in their internal incentives. Managing to short-term targets might boost the share price for a while, but this short-termism can weaken the long-term franchise value of the bank. I think we've seen some examples of this recently. I would argue that the franchise value is more likely to be maximised if our financial institutions have a long-term perspective, if they treat their customers well, if they reward loyalty rather than take advantage of it, and if they invest in systems and technology that deliver world-class financial services for Australians. In my view, doing this would not only be good for bank shareholders, but it would also be good for the broader community. I'd now like to turn to the second issue, and that's a slightly different concept of trust, but in my view, it's one that's no less important. and that is the community's trust that real living standards will improve over time. On many accounts, the Australian economy has performed very well over recent times. Over the past year, it's grown by close to 3.5%. Inflation's been low and stable at around 2%. Employment has grown quite strongly, and we're getting quite close to full employment. I think you can see the general picture in this first chart here, if I can... I don't know whether someone... Yeah, there we are, thank you. So, overall, it's a very positive picture. Business conditions are positive, and government finances have also improved in reasonable shape. There's a lot of investment taking place in the economy, particularly in infrastructure, and the number of job vacancies is at a record high. The unemployment rate in New South Wales and Victoria is back to where it was in the early 1970s, so more than almost 50 years ago. So overall, it's quite a positive picture. Yet despite how often this story is told, not everybody shares this positive assessment. As Paul said, not everybody feels connected to the progress that I see from a macro point of view. This next graph helps explain why this is the case. It shows how average hourly earnings in Australia, adjusted for inflation, have changed over time. I think the picture's pretty clear. Over the period from 1995 to 2012, we witnessed a substantial lift in real hourly earnings. On average, real wages increased by almost 2% a year, and that resulted in a substantial increase in people's real living standards. This occurred alongside inflation averaging around the midpoint of the 2 to 3% range, and with strong growth in corporate profits. Since 2012, though, it's been a different story. Over these 6 years, there's been very little change in average real hourly earnings. The increases in wages that we've seen have been broadly matched by inflation. This is quite a change, and it's having significant effects. On the positive side, flat real wages have supported the substantial gains in employment that we've seen, so they've benefited many people. At the same time, though, flat real wages are diminishing our sense of shared prosperity. The lack of real wage growth is one of the reasons why some in our community question whether they're benefiting from Australia's economic success. This is not a uniquely Australian story, though. A similar thing has happened in many advanced economies around the world. And as a result, too many citizens around the world have diminished trust in the idea that the policies that have underpinned growth over the past 30 years are working for them. They feel more uncertain about the future, and in some countries are also having to deal with very high housing prices. This unease is occurring despite the fact that unemployment rates in many advanced economies being the lowest they've been in many decades. The diminished trust in the idea that living standards will continue to improve is a major economic, social and political issue. Arguably, it's the most important issue we face. It underlies some of the political changes that we're seeing around the world. It's also making it harder to implement needed economic reforms. It's in our collective interest that this trust be restored. This is a challenging task for us, but it's not an impossible one. Part of the solution is for the labour market to tighten further and for this to lead to a pickup in household income growth. The current setting of monetary policy is encouraging exactly this, and it's working. As the labour market has tightened in Australia over the past year, there has been a modest lift in wages growth, and we received further confirmation of this last week with the publication of the Wage Price Index. The RBA also continues to hear reports of larger wage rises in areas where there's strong demand for labour and workers are in short supply, and I expect that we'll hear more such reports over time. So this monetary policy strategy that we have of keeping interest rates low and tightening up the labour market, I think it's gradually working. From a longer term perspective, another part of the solution is to boost productivity. The factors that are contributing to flat real wages for many workers are complex, but many of them are linked to globalisation and to technology. And the best way of dealing with this is not to ignore these forces, but to do what we can to capitalise on them. This means government and business having a sharp focus on the question of how we can best flourish in a world of global markets and continuing improvements in technology. An important part of the answer must be investment in education, and skills development, and in research and development. I think we need to be thinking long term here. Realistically, more investment in human capital will not make much of a difference to real wages this year or next. But over the next decade or two, it's crucial to raising real wages and living standards. Increasingly, our prosperity rests on the ideas that we have, on how we can take advantage of those ideas and how we capitalise on new technologies. This means having a very strong culture of innovation in business. It's very important. With the right investments, I'm confident that Australians can enjoy high and rising real wages in a highly competitive and technically sophisticated world. There are, of course, other elements to lifting productivity. These would include the design of our tax system, the quality and pricing of our infrastructure, and the strength of competition in our markets. We need to keep these areas all in focus. The key point here, though, is that raising productivity and ensuring a strong economy will, over time, help deal with the diminished trust that people have in the idea that their real living standards will improve. As I said before, we all have a strong interest in that trust being restored. Without it, a lot of things become more difficult, not just on the economic front, but the social front as well. I'd now like to turn to the third aspect of trust, and that is trust in public institutions. One of Australia's strengths is that we have strong and stable public institutions. We can sometimes take this for granted, but strong public institutions are one of the foundations upon which our economic prosperity is built. They help support the public's trust in the development and implementation of economic policy and in the fair and effective administration of laws and regulations. And they can also help society balance some of the difficult trade-offs that we sometimes face. I hope that you see the Reserve Bank of Australia as one of those institutions. We have been entrusted with important responsibilities by the Australian Parliament. These include determining Australia's monetary policy, issuing Australia's currency, operating the core of Australia's payment system, acting as banker for the Australian government, and having broad responsibilities for financial stability and for competition, efficiency and stability in Australia's payment system. It's a long and important list. As we carry out these important responsibilities, I'm very conscious that as a central banker, I'm an unelected official acting on the public's behalf. Reflecting this, the first of our internal values that we use at the RBA is to act in the public interest. We work hard to be worthy of the trust that's been placed in us. We seek to do this by speaking and acting independently, consistent with our mandate, by being analytical and pragmatic in our approach to policy, and by being accountable and transparent. One element of transparency is the release of minutes after each of our monthly board meetings. The latest minutes were released this morning. These contain our assessment that the Australian economy has been doing well recently. It's growing a bit faster than average, the unemployment rate is trending lower, and inflation is low and stable. And we expect this to continue for a while yet. This is evident in this next chart, hopefully, which shows our updated forecasts. Growth this year and next is expected to exceed 3% before tapering off in 2020 as the boost from the large increase in LNG exports tapers off. Inflation is also expected to pick up, but only to pick up gradually, and inflation is expected to remain low, as you can see. The graph also shows the range of uncertainty based on historical experiences. The public focus is normally on the central scenario, but it's important to recall that the range of possibilities around that central scenario is quite large. As the minutes discuss, one of the current sources of uncertainty is the pace of growth in consumer spending. Over the past couple of years, consumer spending has been growing reasonably firmly and faster than disposable incomes. Our central scenario is for household spending to continue growing at around its current rate and for income growth to pick up to be in line with spending growth. But there are conflicting forces at work here. On the positive side, the strong employment growth that we've been witnessing is a plus for income and consumption growth. But working in the other direction are flat real wages at a time when debt levels are high and housing prices are falling in our largest cities. So we're continuing to assess the balance of these forces carefully. As we do this, we're watching the housing market closely. There has recently been considerable public attention to declining house prices in Sydney and in Melbourne. It's important, though, to remember that these declines come after very large run-ups in housing prices in these two cities, which made purchasing a home difficult for a significant number of people. You can see the large gains in housing prices over previous years in this next chart. There we are. Over the previous decade, housing prices in Sydney increased by almost 100%. So we had a very large run-up in prices, and there's been a modest retracement of those gains. It's also worth pointing out that this adjustment is taking place against a backdrop of a strong world economy, a positive Australian economy, low and declining unemployment, low interest rates, strong population growth, and only limited pockets of excess supply in the housing market. And this is a reasonably favourable backdrop against which to be having an adjustment in our housing market, but we do need to watch things closely. The minutes also report that the board evaluated the forecast made by the bank this time last year. And the board does this type of evaluation exercise each year. Over the past 12 months, the economy has performed more strongly than we expected a year ago, and the unemployment rate has come down by more than was expected. At the same time, though, the stronger growth and the stronger labour market did not translate into more inflation. Wage growth and inflation turned out to be pretty close to what we thought they were going to be a year ago. The fact that growth was stronger than expected is largely accounted for by a positive surprise on investment. The terms of trade have also been stronger than we thought, which combined with a lower exchange rate has helped. The positive story for non-mining investment can be seen in this next graph, which shows the bank's successive forecasts over the years for non-mining investment, as well as the actual outcomes shown in the black line. So I think you can see for a number of years we were forecasting a lift in investment that did not materialise. During this period of flat business investment, Glenn Stevens gave frequent speeches bemoaning the lack of animal spirits in the business community. But over the past couple of years, things finally turned around. The long forecast pickup in investment finally arrived, and it's been stronger than we expected over the past couple of years, and we expect this upswing in investment to continue for a while yet, so that's positive news. In the context of its forecast evaluation, the board also reviewed the various arguments that have been made by commentators for alternative courses of monetary policy. The timing of this review has no particular policy significance. It's simply good practice for us to consider the issues and arguments from all angles, and we do this as part of our regular evaluation exercise. As you know, following its deliberations a few weeks ago, the board again decided to maintain the cash rate at 1.5%, where it's been since August 2016. The central messages also remain the same. First, the economy is moving in the right direction, and further progress is expected in lowering unemployment and having inflation consistent with the target. The second message is the probability of an increase in interest rates is higher than the probability of a decrease. If the economy continues to move along the expected path, then at some point it will be appropriate to raise interest rates. This will be in the context of an improving economy and stronger growth in household incomes. The third and final point is that the board does not see a strong case for a near-term change in interest rates. There is a reasonable probability that the current setting of monetary policy will be maintained for a while yet. This reflects the fact that the expected progress on our goals of reducing unemployment and having inflation consistent with the target is likely to be only gradual. The board's view is that it is appropriate to maintain the current setting of monetary policy while we make this progress. Thank you very much for listening, and I look forward to your questions in a little while. Thank you.